Hello, good evening. How are you? I hope you guys are doing well. Okay, so welcome to the third class of the financial accounting, and today we are going to start with a newer topic. This is something all-time famous topic as far as for the financial accounting is concerned, and this is a kind of sort of a basic topic as well, which is going to sort of like clear our understanding regarding the double entry bookkeeping system as well. Plus, along with that, it will be giving us an idea about the movement between the expense and the income as far as the liability and the assets are concerned, right? So the starting topic is the discounts. This is what we have to start with. Now, discounts or discount, this is called as the decrease in value, right? So any decrease in value that we have, that's called as a discount, down $150, right? You bargain with the seller and then you end up getting the shoes for $110, right? This is the eventually you buy them for 110, right? Now, the price of the shoes, which was 150 quoted by the seller, you ended buying them for 110, right? So difference this difference of $40 over here is going to be called as a trade discount or a bargain discount, right? Now, suppose you buy in bulk, right? And the supplier offers you a discount as well. That bulk discount is also going to be called as a trade discount. Now, the beauty of the trade discount is that the trade discount is never ever recorded in the books. The transaction and recording of it is triggered after accounting for trade discount, right? Like for example, you go to a shopping mall and now the big brands, they have put on a discount, right? I mean, before the discount, the price listed price is something else, but they have okay, so welcome to the third class of the financial accounting, and today we are going to start with a newer topic. This is something all-time famous topic as far as for the financial accounting is concerned, and this is a kind of sort of a basic topic as well, which is going to sort of like clear our understanding regarding the double entry bookkeeping system as well. Plus, along with that, it will be giving us an idea about the movement between the expense and the income as far as the liability and the assets are concerned, right? So the starting topic is the discounts. This is what we have to start with. Now, discounts or discount, this is called as the decrease in value, right? So any decrease in value that we have, that's called as a discount. And the types of discounts, if we talk about, we have a trade discount, and then we have a settlement or cash discount as well. Right now, trade discount is something which is also called as a bargain or a bulk discount as well, right? And basically, this is something which is available because of the nature of the trade that we have, right? Like for example, you go to the market and you look at a pair of shoes, right? And that is for like around $150, right? You bargain with the seller and then you end up getting the shoes for $110, right? This is the eventually you buy them for 110, right? Now, the price of the shoes, which was 150 quoted by the seller, you ended buying them for 110, right? So difference, this difference of $40 over here is going to be called as a trade discount or a bargain discount, right? Now, suppose you buy in bulk, right? And the supplier offers you a discount as well. That bulk discount is also going to be called as a trade discount. Now, the beauty of the trade discount is that the trade discount is never ever recorded in the books. The transaction and recording of it is triggered after accounting for trade discount, right? Like for example, you go to a shopping mall and now the big brands they have put on a discount, right? I mean, before the discount, the price listed price is something else, but they have given a 30, 40, 50% discount. So eventually, the transaction triggers after accounting for the discount. I mean, it never happens like this. And in this case as well, say in case you are going to give 150 to the to the shopkeeper or to the seller, stating here you go your amount, and then out of that he is going to take out the 40 and he's going to give you back, and he's going to say here you go, this is your discount over here, right? It doesn't happen like this because we eventually pay the net amount that we are supposed to pay, right? So that is why the trade discount is never ever recorded in the books, right? Okay, now settlement discount. Settlement discount is also called as a cash discount as well. Now, this settlement discount of the cash discount is the discount available from the supplier to the buyer for early payment, i.e., to encourage the buyer to do early payment, right? So this discount is basically available, right? This discount is available from the supplier to the buyer for the early payment. That is to encourage the buyer to do the early payment, right? And this is going to be, I mean, if the supplier is, encouraging you to do the early payment or something, then it means this is the discount which he is offering. Like, for example, you buy goods from a supplier for $100. The supplier gives you a normal credit period of 30 days, but at the same time but offers a 5% discount if the payment is made within 15 days, right? Now you have bought the goods from the supplier for $100, right? The supplier has given you the normal 30 days period, right? Now, at the same time, he has offered you a 5% discount if you made the payment within the 15 days. That is, if you pay him early within the 15 days, then in that case, he is going to give you a discount of 5% over here, right? So overall speaking, when you have bought the goods, right? So you are going to do the double entry over here as purchase debit 100 and your supplier credit with 100. Now, if you take up the normal credit terms, that is, you pay after 30 days, right? In that case, you are going to debit the supplier with 100 and you are going to credit the cash with 100, right? But if you decide to take up the 5% discount, right, then you are going to debit the supplier 100, you are going to credit the cash with 95, and you are going to credit the discount receive of 0.5. This discount receive is going to be recorded as increase in income over here, because you had a liability of 100, and for the settlement of liability you just paid 95 and got the discount for the rest of the amount. So basically your liability has been reduced over here. So if your liability has been reduced over here, this is something which we are going to call as the discount receive over here. Right now, from seller's point of view, I mean, let's say we are the seller, then we are going to debit the customer with 100, and we are going to credit the sales with 100, right? I mean, if we are the seller, then obviously we are going to debit the receivable, or the, the debtor or the customer over here, and we are going to credit the sales. Right now, if our customer doesn't take up the discount, then we are simply going to debit the cash with 100, and we are going to credit the customer with 100. And if our customer opts for discount, then we are going to debit cash 95, debit discount allowed of 5, and credit customer with 95. So here the discount allowed is going to be increase in expense over here. Discount receive is an income, and the discount allowed is an expense, right? So I can just simply sum up my whole, the concept over here, and the points which you have to remember. Points to remember. Number one, discount allowed, that's an expense. Discount received, that's an income. Okay, then discount allowed, it decreases our asset, that is receivable. Whereas the discount received, it is basically decreasing or decreases our liability, that is payable, right? Then discount allowed doesn't affect the sales value, and discount received doesn't affect the purchase value, right? So this is what we have to keep in our mind over here, right? Regarding the, what the effect is going to be over here, right? So these are the points which you have to remember over here, that discount allowed, it's an expense, discount received, it's an income. Then the discount allowed is basically going to eventually decrease the amount or the balance of the asset over here, that is the receivable, and the discount received is basically going to decrease the amount of the liability or the payable over here. Then the discount allowed is not going to affect the sales value, and the discount received is not going to affect the purchase value as well, right? So this is what you have to keep in your mind over here, right? Done? I hope it's clear to you. Okay. Now, moving ahead from here, I mean, this is the maximum thing that you can have. Let's just talk about a little different example over here, and then obviously we'll move forward. And that is, Suppose an entity sells goods with a list price of $10,000, right? Trade discount offered is 10% and settlement discount is offered for the payment made within 10 days, right? Do the double entries assuming the discount will be taken, right? So what do we have to do over here is we have to assume that the discount is going to be taken. So we have to pass the double entries over here, right? Now, how are we going to do that? Okay. So first thing first, we are going to debit the receivable. Then we are going to credit the sales. All right. Now, as far as the receivables are concerned, simply have 10,000, 10%. That's going to be 1,000 over here. So the remaining balance is going to be 9,000. So receivable debit, sales credit. And then when it comes towards the settlement, we are going to debit the cash over here. We are going to debit the discount allowed over here. And then we are going to credit the receivables over here. Now the receivables are 9,000. Now further discount is offered. Okay, and 5% settlement discount is offered, right? So now what we're going to do is we'll take up the 9,000, take just 5%, and that is going to be 450 over here. So 450 is going to be there. Then 9,000 minus 450, we get 8,550 over here. So we'll record this up into the discount allowed. Sorry, discount allowed is going to be 450, and the cash which we are going to eventually receive is going to be 8,550 over here, right? Okay, I hope it's clear to you, right? Now, with the context of the discount, we have another thing being called as the sales tax over here, right? So understanding of the the discount, I mean, it goes by with the understanding of the discount, sorry, with the understanding of the sales tax as well. Now, if we talk about the sales tax is a form of indirect tax, right? Sales tax is eventually borne by end user. Sales tax is charged on inputs, that is purchases, and outputs, that is sales. Now, tax on purchase. Now, tax on purchase is called input tax, and tax on sales is called output tax. Done? Now, these are the basic points that we have over here. Tax, this is a sort of the biggest source of earning for the government, right? Tax is the biggest source of earning from of the government over here. If we talk about, there are multiple types of tax, and one kind is called as the sales tax as well. Otherwise, there is income tax, there's corporation tax, there is the capital gain tax, there is inheritance tax, right? And the VAT or the sales tax, they are the one and the same thing. VAT means the value added tax over here, right? In the UK, if we talk about the tax department, is HMRC, that is Her Majesty Revenue and Customs, and that department is responsible for the administration of the tax activities, right? None of the tax departments, I mean, specifically talking about the UK, the tax department is not responsible for the collection. It's responsible for the administration only, as far as for the tax matters are concerned, right? People, on the other hand, they are responsible on their own to file for their return, right? So this is what the basics are. So sales tax is obviously going to be a form of indirect tax. This is not a tax which is directly like the government is charging to you. Basically, it is what happens is it's like being gonna be ultimately borne by the end user, the one who is going to be the end user of the product. He is actually going to be the one who will be paying the tax actually to the government, right? Eventually, that is the tax which is going to be taken out from his pocket and is going to be paid to the government, basically, right? So what happens if you are an intermediary party? I mean, for example, you bought the goods from the supplier. So technically speaking, if you are registered for the tax or not, if the supplier is registered, he's going to deduct your tax, right? Now, if you are registered for the sales tax, obviously you can claim the input tax, you can charge the output tax. But if you are not registered for the sales tax, then you cannot claim the input tax, and similarly you cannot charge the output tax, because if you're not registered for the sales tax, then how come you can deduct the tax from the government's behalf? You cannot, right? And then the third point is, now saying case if you bought the goods from the supplier and then you sold the goods eventually to the third party or to the customers, the end user, right? So the amount that you paid to your supplier as a tax, that is something you are going to charge to the customer, right? Like for example, let me just clear you out over here. This is the supplier over here. From the supplier, you got the goods, and then you eventually sold the goods to your customer. From the supplier, you are buying here, and then you are selling here, right? Now, the goods were for 100 over here, in which you charge the tax at 10. So you had the tax of 10 over here, right? Let's say you had the goods from the supplier for 100, in which you had the tax of 10 as well, right? And then eventually you are going to sell the same goods to the customer now. So obviously you will sell them at a higher value or something. Let's say now you sell these goods to the customer for 150, and in this 150 there is a $15 tax in it, right? So this amount this amount of the tax is something that you are paying to the supplier, and this amount of the tax is something you are getting from the customer, because when the customer is going to pay you, he'll pay you the 150 now. So in this 150, this 15 is already over there, right? Because this is something which the customer is paying you, because this customer is paying you this amount over here. Now what is going to happen is, you paid the 10 to your supplier. Now you got the 15 from your customer. What you're going to do is, you take out the 10 which you actually paid to your supplier. This one, now this 10 is going to be deducted from here. You are going to put it in your pocket, and this 5 from here, this dollar 5 from here, is something that you will pay to the tax authority. And this supplier, this 10 is something which this supplier is going to pay to the tax authority over here, right? Okay, let me just fix it up. Much better. Right, so this supplier will pay the 10 to the tax authority, you will pay the 5 to the tax authority, and eventually the tax authority is going to receive 10 plus 5 is 15, which the customer over here has paid, right? But you will pay 5 and the supplier is going to pay 10 over here, right? So total, eventually the government receives a 15. So one thing is for sure and clear, that the end user is the one who has to pay the tax. End of story, right? And we over here have the supplier and ourselves and the customer as well. And user is eventually going to bond this up, and you, the intermediary party, who for now, although has paid the tax, but eventually is going to have a refund for that, right? So the tax on purchase is called as the input tax, and tax on the sales is called as the output tax. This is what the whole story is. This is what we are going to talk about with lots of twists and turns in order to understand that what is happening. Nothing more than that, right? Nothing more than that. This is what we have to talk about and we have to generally discuss over here. Okay. Now, let's say, let's say we purchased goods costing 10,000 excluding tax. What is the double entry to record this purchase? We are going to debit the purchase with 10,000. We are going to credit the creditor or payable with 10,000, nothing more. Right? So we purchase the goods costing 10,000 excluding tax. What's the double entry to record the purchase? We are simply going to debit the purchase. We are going to credit the payables of the creditor with the 10,000, right? Not no fancy entry. Simple. This is what we have been doing so far. Now, we purchased goods costing 10,000 excluding tax. The tax is charged at 10%. What is the double entry to record the purchase? To record this purchase, assuming we are not registered for sales tax. Registered for sales tax, right? Now, if we are not registered, if we are not registered for sales tax, then simply debit purchase and credit payables. Right now, we have this 10,000 in which we have a 10% tax as well, now. So the total amount is going to be 11,000 over here. Similarly, the payable is going to be recorded as 11,000 because the 1,000 is the tax over here. And now look, the purchase is going to be including tax because the taxes, we are not registered for the tax, and this is something we won't have the relief for, right? So our cost is going to increase. Our expense is going to increase because the amount which we have paid to the supplier over here, this amount which we have paid to the supplier over here, now it's not gonna be refunded to us, right? And if you are registered for sales tax, if you are registered for sales tax, you will debit the purchase with 10,000. You will debit the input tax as 1,000 and you will credit the payables with 11,000, right? Okay, let's just have it over here because I have to mark some lines over here. Now, remember this thing. Now, remember this thing. Purchases, they are always net of tax. Input tax, this is reclaimable from government. Payables, always gross of tax over here, right? So remember this point over here. Just give me a second and we are resuming. Just 1 second only. Okay, I'm back. So resume now. Okay, so we just talked about over here where we purchased the goods. Now we sold the goods for 16,000, excluding tax at 10%, which were bought earlier for 10,000, excluding 16,000, which we bought earlier for 10,000. Right now, as far as the accounting is concerned over here, now what we have to do is that we have to calculate what is the double entry, now to record the sales. Right now, what's going to happen is we are going to debit the receivables, will credit the sales in normal circumstances where we have the receivables and the sales, right? And plus over here, we'll have the sales tax as well. Right now, 16,000 at 10%, so it means 16,000 plus 10% of that is 1,600, which is 17,600. So the receivables are going to be 17,600. Sales are going to be 16,000, and the sales tax is going to be 1,600. This receivable 17,600 is going to be gross of tax, sales net of tax, then the sales tax. This is the tax liability over here, right? So if we look in the whole scenario, input tax, that's 1,000, this one, this input tax, and the output tax collected over here is this 1,600, right? So net off and pay to government is 600 over here, right? So payable to the government is going to be 600 over here, right? Now, if I move forward, okay, let's just start. Okay. So we have a sales tax account, right? So we have a currency sign over here. We have a currency sign over here. So the tax on purchase is going to be here, and tax on sales is going to be here, right? And then eventually we will have a balancing figure over here or a balancing figure over here. Right now, if we have a balancing figure over here, it means this is receivable. And if it's here, it means it's payable. Right? So this is the sales tax account that we have to make at the end of the day. Right? Now, let's have a bit of a twist over here. Let's have an example. Mr. A bought goods costing 10,000, including tax at 20%. How will this be recorded in the accounts, assuming Mr. A is registered for tax purposes, right? So this is what the example is. Come on, Arya, try to solve this one. right? You have purchased the goods, right? So let me just do the double entry over here. Purchase debit, sales tax debit, credit payable. Calculate the amounts and hurry up. Tell me in the chat box. Hurry up. Come on, I'm waiting. You are just 1 minute only. We don't have much time. Hurry up. Come on. I'm waiting over here. Guys, answer. I mean, it's not that difficult or something. Why are you stuck in the calculation? Are you guys stuck in the calculation or what? Kunal, Kunal, what's your answer? Kunal, you there? Mihir? Yeah, Kunal, come on, speak up.
It's debit purchase 10,000.
Okay,
Uh, the tax is at 2,000.
okay.
And the payable is at 12,000.
12,000 payables. Okay, but it's written over here that the goods costing 10,000 including tax. This is something which already includes a tax in it. This is something which already has the tax in it. So why are you recording this at 12,000 when the total amount which you have paid inclusive of tax is 10,000, not 12, or the amount that you have to pay? It's not going to be 12 over here, right? It should be 10,000 over here, right? Now, on the other hand, if we take the, okay, we have, okay, we got the purchases at 10,000, sales tax as 1,667, and payables at 8,333. Okay. Okay. Let me just help you guys. Let me help you guys. Look over here. Normal thing is that if this is something including tax now, so let's just exclude the tax from this. I mean, if I multiply this 10,000 into 20%, I get what? 2000 over here. So the sales tax is 2000. So technically speaking, my payables are going to be 8000 over here. This is one way of looking at it, right? Because if I take the 10,000's 20% over here, that's going to be 2000 over here. I'll put the 2000 over here and then I'll have my purchase over here for the 8000, right? Done. If I do this entry like this is going to be wrong over here. This is wrong over here. Why? Because I've written the purchase at 8,000. Now look over here. This is 8,000. Let me take up the 20%. What is this? 1,600. At what amount am I recording the tax over here? And now the best thing is, if this is 1,600, fine, agreed upon. 8,000 plus 1,600 is 9,600. I have a total amount of 10,000 over here. So this cannot add up to the 10,000 as well, right? So this is not the answer. Now, how to get the answer for this? The answer is, I mean, if we try to put up the equation over here, the equation is purchase. We have the purchase. We add up the 20% of purchase in it, and then we get our total purchase price, right? Now, this is the rule of the maths, that whatever's or whichever thing we have the percentage of, right? Whatever the element we have the percentage of, we are always going to assume that that is the 100%. I mean, if you have the percentage of A, that is going to be assumed as 100%. If you have the percentage of X, you are going to assume that the X is 100% and all, right? So this is the maths rule which always go by. So this is going to be 100% plus 20%. So you'll get a total of 120% over here, right? Now, if we go over here, you have total purchase of 10,000 over here, nothing more. Now, this 10,000 is 120%. So if you divide it with 120, you'll go to 1%. And now multiplied to 100, you will get your purchases. 10,000 by 120 into 20, you will get your sales tax over here, right? So the purchases are 10,000 by 120 into 100. That's going to be 8,333, right? And the sales tax is going to be the difference over here. And that's going to be 1,667 over here, right? Okay, Mihir, your calculation up to this point was right. But when it came towards assigning the values were concerned, you were wrong. Okay, now look, the double entry is going to be, we are going to debit the purchase with 8,333. We'll debit the sales tax or input tax at 1,667. And then we are going to credit the payables with 10,000, right? This is how we are supposed to, calculate our tax over here, right? I hope it's clear to you. Now, let's see how much is it clear. Okay, we have amount including tax. This is the rate of tax. This is the amount excluding tax, and then this is the tax over here. This is 180,000. This is 17.5%. This is 357,000. This is 20% over here. This is 20,000. This is 25%. This is 467,500. We have 10% over here. And then this is 118,950. And this is 34% over here, right? Okay, guys. solve this for me. I want to see how you are going to calculate. Okay, let me just show you. I'm going to solve this 467,500 for you. Look, this is the amount including tax. Now, this is the rate of tax. So this means it is already included in the 100%. Now, so this is 110. So 467,500 by 110 into 100. We are going to have 467,500 by 110 into 100. That is 425,000. And then over here, we'll have the difference 467,500 as 42,500. Right? Now, hurry up. You have 5 minutes. Solve all of these remaining amounts for me. I'm right over here if you need any help or something, okay? But you have to get it done right now so that you get done. I mean, clearly as far as your whole concept is concerned. I'm waiting. Come on, hurry up. Okay. So, Bhagwa, I can look at the answer, but how am I supposed to understand? And same is the case with the without. Okay, I can understand. Okay, 153,191. Tax is 26,809. Okay, okay, you guys have the answer. Let's see now. That's gonna be 180,000 by 117.5 into 100, right? So we get 153,191. Then for this is gonna be 357,000 by 120 into 100. And for this is gonna be 20,000 by 125 into 100. And then this is going to be 18,950 by 34, sorry, 134 into 100, right? So these are the, like, the fractions that you have to do over here, right? And rest of the answers, I hope you guys have gotten, right? Now, moving ahead from here, let's just talk about more refining of this T account. Here we go. Now, we can have an opening balance over here. That is the receivable balance. I mean, if we have to receive any amount from the tax authority, then the balance is going to be over here. We can have an opening balance over here. That is for the payable, right? If we have to pay to the tax authority. Then similarly, we can have a cash receive over here that is refundable, right? Over here is going to be the refundable. And then we can have a cash paid over here, right? I mean, that is something like, which is the payable over here, right? At the end of the day. And then we get this balancing figure over here, right? So this is the whole, account with us. But again, this balancing figure is now going to be the closing balance over here, right? This is going to be the closing balance figure over here, right? And this is the complete picture for the as far as the uh, account is concerned, right? Done? Okay, now let me just copy up the questions and then we're gonna start doing the questions over here. Just give me a minute, okay? Just let me just copy the questions, okay? We at the end we are resuming. Okay, I'm back. So let's resume now. So this is the question number one. If an invoice states settlement terms are net 30 days, this means that. Now, whenever it's written on the invoice that the net 30 days now, so it means the invoice is payable gross of tax, I mean including tax because you don't pay the tax separately and the amount of the invoice separately. So that's going to be the gross of tax, right? That is payable within net 30 days mean that's payable within the 30 days, right? From the date of the receipt of the what invoice, okay, not the goods but the invoice over here, right? So the correct option is going to be the invoice amount gross of VAT is payable 30 days from the invoice date over here. So this is going to be the answer, the correct answer. Here we go, right? So the correct answer is going to be the invoice amount gross of tax is payable within 30 days from the invoice date over here. Done. Then next question is VAT registered sell goods 1200 net of VAT and purchase goods costing 200 gross of VAT. How much VAT is due or payable? Okay, let me just copy these questions. I'm thinking to copy these questions to the Excel. Okay. I guess Excel is more a property. I've just created the notes bulk chunk over here now that you have the reference of the questions over here. Now, for the sake of solving, I am taking you to the Excel because it's going to be much easier over there to, create the T account and then to get along. Here we go. Okay, here we go. Okay. Let me just fix it up. Okay. And fix. Here we go. Here we go. Here we go. Right. And then let's just copy some more questions. Okay. So we have multiple questions over here for now, and then we'll copy more. Okay. Now it says a VAT registered business sell goods 1200 net of VAT and purchase goods costing 200 gross of VAT. How much VAT is due or payable from the HMRC? That is the Home Registered Revenue and Customs, and the tax is at 17.5%, right? So what we're going to do is we are going to create a T account over here. There we go. And margin center, we have this tax account over here. Here we go. Okay, now VAT registered business sells goods. Sells, right? So that is basically the sales tax over here, right? I mean, if it's selling the goods, then that is something going to be the sales tax over here, right? And the amount is 1200 net of tax, right? So if it's 1200, we have to take up 1200 into 17.5% net, na? So that is why we are just simply going to multiply the 17.5% to that. So that's going to be 210, right? And then and purchase goods costing 200 gross of VAT. So purchase tax is over here, and that is 200 gross of VAT. Gross of VAT means there is like, the tax already included in this. So 200 by 117.5 into 17.5 is something we are going to get the tax on the purchase, right? So 200 by 117.5 into 17.5, we get what? 30 over here. Now, the balancing figure is going to be on this side. So 210 minus this one, we get 180. And if here is the figure, we have seen the standard T account that if we have a figure over here, so it means that this is a payable balance. So the VAT payable is going to be 180 over here. Why 180 payable? Because this is the amount of tax that we have charged on the sales, and this is the amount of tax that we have paid on our purchases, right? So we have charged more and we have just paid 30 in the name of the tax over here, right? So the extra, which is still payable back to the government, is 180 over here, right? Okay. Then moving it from here. Okay. Let's see the next question. If sales including VAT amounted to 27,612.5 and purchases excluding VAT amounted to 18,000. The balance in the VAT account, assuming all the items are subject to VAT at 17.5%, would be. Okay. So I have this sales tax 27,612.5 by 117.5 into 17.5. That's 4113. And then we have a purchase tax. That's 18,000 purchases excluding VAT now. So that's going to be 18,000 into 17.5. So that's going to be 0.175 over here. Done. So automatically we'll have the balance figure on this side because this side is heavier. So 4113 minus 3150, we get 963 over here. Okay, now look. That's 962.5 over here, right? Now, this balance is going to be called as credit balance. Okay. This is going to be called as the credit balance because this is because of the heavier credit side over here now. So that's a credit balance. So this is a payable, right? This is a payable. This is a liability. Done? Okay. Then moving ahead from here, let's just talk about another question as well. Hairdressing Supplies Limited has recently purchased supplies from internal toiletries for 250 less 20% trade discount plus 17.5 VAT. Internal toiletries allows 2.5% cash discount for payment within 7 days of the receipt of their invoice. Which of the following net amount is due for payment by hairdressing supplies if they take advantage of the cash discount? Now, talking about this situation over here, where you have a trade discount, you have a settlement discount or a cash discount, and then you have the tax as well, right? Now remember this point and listen to this point really very carefully. Tax authority, tax authority has simply created a rule. No matter the customer takes up a settlement discount or not, the customer avails the settlement discount or not, for the sake of calculating the tax, you are always going to assume that the customer is going to take the advantage of the tax, right? For the sake of calculating the tax, you always have to assume that the customer will take the advantage of the discounts, right? Whatever the discounts are mentioned in the question, because eventually the tax, it has to be calculated on the net amount. The tax at the end of the day, it has to be calculated on the net amount, right? So what we are going to do over here is, okay, we have a purchase of 250 over here, less trade discount. Trade discount is 20%. So I'm going to take 20% of this. And when I do, I get net amount of 200 over here. Then I'm going to less the settlement discount, 2.5% cash discount for payment within 17 days. Nah? And this 2.5% is going to be of this amount, 2.5%. That's going to be 5, right? So net amount over here is 195, right? Now, tax is 17.5% over here. That's 34. And if I do the total, the amount net which I'm going to receive is 229.13. So that's 1 2. This is going to be the answer over here. Right? Option C. Done? Okay. Now, which of the following statements about VAT is true? Now, we have to talk about this statement over here. A debit balance on the VAT account means that you owe money to HMRC or the Her Majesty Revenue and Customs or Customs. Customs and Excise is the old name. This is the old name over here. This is HMRC, not CE. Right? So the debit balance on the VAT account means that you owe money. No, you don't owe money. Debit balance means that you have to receive the money. So the first one is wrong. Then for zero rated supplies, you can reclaim input VAT, but do not need to charge output VAT. This statement is true. Now, let's just talk about this one, zero rated supplies. Zero rated supplies are the supplies on which basically you do not have to charge the tax, or the government has said that you are not going to charge the tax on that. Like, for example, anything that you make for the benefit of the humanity, like for example the wheelchairs, for example the sticks or the walkers, why which the old people or the people with a disability, like they walk with now. So such items that you make, they are going to be classified as the zero rated supplies, and normally the tax is not charged on them, right? So like say in case you are taking the raw material now from the leather for which is used for the wheelchair now, I mean it's not necessary and it's not known to the supplier that what you're going to do. Either you will be making the jackets or you'll be using it for the seat of the wheelchair. Similarly with the wheels and the tires, they don't know either you are going to use them into the bicycle or you are going to use them into the the wheelchairs and all that. And same goes with the metal as well, right? So for the zero rated, you can reclaim the input VAT. I mean, obviously, you are going to get the amount that you have paid in the name of the tax from the government, but at the end, you are not going to charge the output tax over there, right? And then the amount shown in debtors are inclusive of VAT. So yes, this is true. You always show the amount that the customer has to give you, and that is always something which is gross of tax over here. So 2 and 3, this is going to be the correct answer over here, right? So this is going to be the correct answer over here. Done. Now, let's just have a break. We're going to come back like after 5 7 minutes or so is concerned, and then we'll resume the question. And meanwhile, I'll copy more questions, right? And then once we come back from the break, we'll resume them. Okay, let's have a break. Okay, I'm back. So let's resume now. So we got to start now the question number 6 over here, and that is during a 3-month period, a business made sales of 72,145 including tax and purchase of 52,200 excluding VAT at 17.5%. There was an amount due to customs and excise at 17.5% at the start of the 3 months period, totaling 1354. What was the balance in the VAT account at the end of the 3 months? So this is what we have to do over here. So I am going to copy the accounts over here. Now, sales of 72,145 now. So sales tax is over here. That is 72,145 by 117.5 multiplied by 17.5. That's the sales. Then we have the purchase tax over here, 54,200 excluding tax now. 17.5. And then the balance at the start of the month was due to na. So that is going to be the opening balance 1354. Right? And then we are going to have definitely our closing balance over here. That is going to be the sum of these two minus this 2614 over here. So this is the correct answer, right? 2614. Then Milan purchased goods on credit last week for 200 including VAT. Milan has now decided to return the goods as they are faulty. What double entry will she post in her accounting records? Now, first she bought and now she wants to return, right? So the logical thing is that she is going to pass the double entry for the purchase return over here, right? Now, when she's going to purchase, she will do the double entry as purchase debit, tax debit, and payable credit, right? And now, when she has to return, she will reverse this entry as debit payable, credit tax, and then credit purchase return. So we have debit payables or the creditor, credit returns, credit tax or what. So option D is going to be the answer, right? Then Victoria sells materials to Fraser for 240 plus VAT. Fraser manufactures from these goods or from these materials and sells them to a customer, Alan, for 360 plus VAT. Victoria and Fraser are registered for the tax, and the goods rate of VAT is 17.5%. Now, how much is VAT paid to HMCE by each party? How much is the VAT is going to be paid by the parties? Now, first over here, if we see this is Victoria. Victoria has sold the goods for 240. So it means this is 240 into 0.175. Victoria is going to pay 42 over here. Then Fraser, he has input tax for 42. As far as for the output is concerned, he sold the goods to Helen for 360 plus VAT, na? So 360 into 0.175, right? So 63, he has a payable balance. 42, this is the receivable balance. So net, he will pay, that is 21, right? So Victoria has to pay 42, Fraser has to pay 21, and Helen, who bought the goods, Helen will pay this 21, right? This is the eventual that the Helen has to pay. No, sorry. Alan has to pay 63. My bad. Not 60, 63. Not 21. 63. Because this is the output now. So for Alan, this is going to be input now. Right? So if I see as a final verdict, I mean, if I take it back from here, this is 21 that he has to pay. So Fraser has to pay 21. So Fraser has to pay 21. And the Victoria has to pay 42. Option B. Then apart from B, do we have anything else? This is Victoria 42. Fraser 21. No, Fraser is not 63. This is 21. Option B is correct because over here the Fraser's wrong. Fraser's amount is wrong. Over here the Fraser is at 42, whereas the Fraser has to pay 21 only. So this is wrong over here as well. And over here the Fraser is at 20. No, Fraser is again at 42 over here. This is wrong as well because the Victoria has to pay 42. Right? So our correct answer is gonna be the option B over here. Right? Then a business has an opening balance on the VAT account showing an amount owing to HMRC of 3210. During the period, there was standard rated output of 12,400 excluding VAT and standard rated input of 11,280 including VAT. During the period, 2890 was paid to HMRC. The standard rate of the VAT is 17.5%. What is the balance on the VAT account at the end of the month? Okay, so the opening balance on the VAT account is amount owing to na. So we are going to have this tax account over here, which we are going to make over here. Owing to, amount owing to means the opening balance is going to be over here, 3210. During the period, the standard rated output sales tax, the standard rated output is 12,400 excluding VAT. Na? So 12,400 into 17.5, that's 2170. And standard rated input of 11,280. Input tax is here. This is 11 to 80 including tax. Na? So by 117.5 into 17.5, we have 1680 over here. And then during the period 2890 is paid to HMRC. 2890. So the cash paid is over here, and that is 2890. Right? So 2890, which is paid, is going to be over here. Now, this is 3 and 2, 5, and this is 3. So technically, the closing balance is going to be on this side. Why? Because this side is already on the 5,000. This side is on the 3,000. Nah? Because 3 plus 2 is 5,000. So over here, we have 5,000 balance over here. Over here, we just have 3,000 roundabout. Nah? So the closing balance is going to be over here. So that is sum of this minus this minus this. 810. So the balance of the tax account is going to be 810 over here. Done? I hope it's clear. Okay. Then a business has an opening balance on the VAT account showing a debit balance of 590 and closing balance showing a debit of 460 as well. During the period, there was standard rated output of 4,200 and standard rated input of 6,000, both inclusive of VAT. Okay, now solve this question for me. Let's see how you guys do it. Hurry up, come on. You have 2 minutes. I need the answer straight away. Come on, hurry up. Tell me the answer. I'm waiting. I'm still waiting for the answer, guys. Have you been able to solve it or not? You are taking a lot of time to answer the questions today. I don't know why. I mean, if it's unclear to you or something, I mean, you can ask me, but you should not be taking this much of a time. Please tell me. Okay, let me help you. A business has an opening balance on the VAT account showing a debit balance of 590. So the debit balance is shown over here now, 590. Then we have a closing balance over here, which is also a debit balance of 460. So the debit balance is closed in a crossing now. So this is the debit balance over here. Then during the period, there was standard rated output of 4200 exclusive of tax. So my sales tax is gonna be over here, 4200 into 0.175. Then I have my purchase tax over here, and this is 6000 into 175, right? Now it's asking how much of the VAT payment is received. So the cash received is over here as a balancing figure, and that is gonna be the sum of these two minus this minus this. That is 445 over here, right? So this is going to be the answer over here, right? Then the next one. XYZ company has the following balance extracted from its return inwards. Return inwards, sales return, book for the month. Total, including VAT is 35,250, VAT is 5250, net is 30,000. What is the correct posting? Now, you have to record for return inwards, that is the sales return. What is the double entry for that? Double entry for the sales return. I mean, if you don't get straight away in your mind, first thing you have to do is just pass the double entry for the sales, and that is receivable, receivable debit, credit sales tax, right? And now when there is a reversal, this is going to be debit sales return, debit sales tax, and credit receivable. Right now, total including VAT 35,250 is going to be for the receivables. Then the VAT is 5250, 5250. This is going to be there. Then the net 30,000, that's going to be there. So debit return 30,000, VAT debit, and this. No, we're just not the purchase, it's the sales. So debit sales return, debit sales return, debit VAT, credit sales ledger control account. This one is going to be there. We still have to study about the sales ledger control account. Don't worry, we will do that. But fast forward, this is the receivable ledger. I mean, you can take it as a receivable ledger as well, right? And then we have this one, 12th. Charles sells goods 1200 and buys good 810. Both transactions include VAT at 17.5. They include how much will Charles pay to HMRC in respect of these two transactions. So now one is a sale and one is a purchase. Now let me just show you. If this is the case, we have a sale 1200. We have a purchase, that's 810. Net amount, that is 390. So the net amount is 390 now. And both of these transactions include the VAT. Now, so VAT is inclusive in this. So the VAT is gonna be 390 by 117.5 into 17.5. Right? By 117.5 into 17.5, we get this 58.09 over here. So this is gonna be option A over here. Right? Done? I hope it's clear. Okay, now moving ahead, we have the question number 13 over here, which says on 1st February, the balance on the Josh VAT account was 2400 credit. This is a credit balance. During the month, VAT on the sales was 1050, VAT on the purchase and other expense was 900, and the repayment of 200 was received. What was the credit balance on the VAT account at 28th February? Hurry up, come on. Now at least solve this question for me. I'm waiting. Come on. Let's just get it done. Hurry up, tell me the answer. Be quick. At this time, I need the answer, okay? Come on. Okay. Mihir and Vedat, you both got the answers. What about the other ones? What about the other ones? Okay, now what you're gonna do is I am leaving the other questions as your homework and expect the other questions to be done by you. I am assigning it as your homework, okay? So do these questions. If you come across any problem or something, do let me know and I'll be more than happy to assist you and guide you in this, right? Today, we are going to stop over here. We are not going to rush. It's more than enough for the day. All you have to do is just go through the, the book and the notes or the stuff that we have learned today. Just revise it up. No, extra burden or something. Enjoy the weekend. right? And definitely when we are going to come back, we'll start with the formal topics, right? Because I'm just creating the base over here, right? I don't want to rush. It's just a foundation that we are laying, and gradually we'll take up the pace and everything now. So it's okay. I mean, at times it's good to, like, get free earlier and all, right? Just practice the questions which are left over here. Then if you want to, you can try some questions from the exam kit as well. And obviously, you know what to do if you come across any problem, and that is to contact me onto the WhatsApp, right? So this is all gonna be from my side. If you have any question or something, or if you have anything in your mind that you want to ask or something, you can. Otherwise, we are done for the day. Any question? Anyone? No question? Okay, very good. I mean, you guys are really very much, you know, highly intellectual ones. I mean, who never have the questions or something. Anyhow, next week we will start with the IAS2 International Accounting Standard number 2, that is the inventory. And then obviously we'll jump towards the exam kit as well for its comprehensive practice and the comprehensive understanding of the topic, right? But for that, obviously, you have to wait for the next week for the next Friday to be over here. And definitely for sure, we are going to start the class at the same time, same place, and same channel as well. So in order to see the inventory, you will have to wait for the next week. So till then, take care of yourself, your family, your friends, and the people around you. Have a lovely weekend ahead of you and enjoy it to the fullest. Until we meet again, time to say bye. Bye bye.